Maya makes $200,000 a year, and every year her bank tells her the same thing. You earn too much to contribute to a Roth IRA. For most high earners, that's where the story ends. They shrug, and they walk away from the best tax-free account in the country. But Maya has been quietly funding a Roth anyway, legally, fully, for years. She didn't find a loophole. She found a side door that's been sitting right there in plain sight. They call it the backdoor Roth. Let's start with the wall. A Roth IRA is extraordinary. You put money in, it grows tax-free, and you pull it out in retirement tax-free with no required distributions ever. But the government doesn't let high earners contribute to one directly. For 2026, if you're single, your ability to contribute phases out between $153,000 and $168,000 of income. Above that, the front door is locked. For a married couple, the wall is between $242,000 and $252,000. Maya, at $200,000, is well past it. Front door closed. Now here's the quirk that opens the side door. There are actually two separate rules, and they don't talk to each other. Rule 1, there is no income limit on making a non-deductible contribution to a traditional IRA. Anyone with earned income can put money in. They just don't get a deduction. Rule 2, since 2010, there is no income limit on converting a traditional IRA to a Roth. None. It used to be capped. It isn't anymore. Put those two rules together, and the back door appears. You contribute to a traditional IRA. No deduction, but no income limit either. Then, a little later, you convert that same money to your Roth. Because you already paid tax on it, the conversion itself is essentially tax-free. The money lands in the Roth, exactly as if you'd walked in the front door. For 2026, that's $7,500 a year, or $8,600 if you're 50 or older. A married couple can each do it. It isn't a fortune in 1 year, but a decade of it, growing tax-free, becomes very real money. Now the catch, and this is the one that quietly wrecks most people's backdoor Roth. It's called the pro rata rule. Here's the problem. The IRS doesn't look at your new little non-deductible contribution by itself. When you convert, it lumps together every traditional IRA you own, including any old pre-tax money from past rollovers or deductible contributions, and treats it as one single pot. So imagine you put in your $7,500 after tax, but you also have, say, $92,500 of old pre-tax IRA money sitting around. Now, the IRS says only 7.5% of your conversion is the tax-free part. The other 92.5% is taxable. The clean, tax-free backdoor you wanted just became a surprise tax bill. But there's a fix, and it's elegant. Pre-tax money inside a 401k does not count in that pro rata calculation. Only IRAs do. So if your employer's plan accepts it, you roll your old pre-tax IRA into your 401k first. That empties out your IRA, and now your backdoor conversion is clean again, with nothing to tax. Okay, the backdoor moves $7,500 a year, but for some people, there's a much bigger version, the Mega-Backdoor Roth. It works inside your 401k. Beyond the regular contribution you make, $24,500 in 2026. And beyond whatever your employer adds, some plans let you make additional after-tax contributions, all the way up to the overall plan limit of $72,000. That after-tax money is the raw material. You then convert it to Roth right inside the plan or roll it to a Roth IRA. Suddenly you're not moving $7,500 a year into Roth. You could be moving $30,000 or $40,000. Let's put it together for Maya. She does the regular backdoor, $7,500, and her plan happens to allow after-tax contributions, so after her own deferral and her employer's match, she adds about $37,500 more in after-tax dollars and converts all of it. In a single year, she moves around $45,000 into tax-free territory, while her neighbor, who never heard of any of this, is told he simply makes too much. Now, the honest fine print, because this only works if you respect it. The regular backdoor works for almost anyone with earned income. Just watch the pro rata rule and report it all on a tax form called the 8606. The mega backdoor is entirely dependent on your specific 401k. Your plan has to allow after-tax contributions, and it has to allow you to convert them. Many plans don't. So before you count on it, ask your plan administrator 2 questions. Can I make after-tax contributions, and can I convert them to Roth? And one note of honesty, Congress has, more than once, floated proposals to close these doors. As of today, both are completely legal and widely used. But they are creatures of a quirk, and quirks can change. Maya didn't outsmart the system. She just noticed that the front door being locked doesn't mean the house is closed. This video is for educational purposes only, not financial, tax, or legal advice. The limits are 2026 figures. The strategy depends on your other IRA balances and your specific plan. Talk to a qualified tax advisor before attempting a backdoor or mega-backdoor Roth. If you've ever been told you earn too much for a Roth, now you know that might not be the end of the sentence. Subscribe. Every week we uncover one financial blind spot that can quietly cost or save families thousands, sometimes tens of thousands of dollars. And send this to the highest earner you know. They've probably been walking past that side door for years,